Hello, everybody. This is Professor Tchaikovsky, or known as the accounting professor on YouTube. Accounting professor, not the accounting professor, but there's someone else who has that channel. So today we're gonna go through and talk about depreciation expense. If we can say that correctly, I always have a hard time with it. This presentation is copyright 2008 to 2024. All rights are reserved. Any redistribution is strictly prohibited without my express written permission. Opinions expressed herein are those of myself and do not represent those of Irvine Valley or the South Orange County Community College District. All right, let's go through and do a question. Always exciting. Okay. So right over here, we have continuing with our airports. We've got over here, we've got SFO, purchases equipment for $300,000. The equipment will last for 4 years and will have a salvage value of 60,000. SFO uses straight line to compute depreciation expense. So let's do the easy part first. Using T accounts, prepare the initial entry to record the purchase of equipment on 5/1/25. Okay, so equipment, debit, 300,000, credit cash. And again, when we're going through and recording the purchase of equipment, right? So we've got over here, my assets are equal to my liabilities plus my owner's equity, ER, and then D and C, or debit and credit. So when we're purchasing equipment, we basically do it with a debit. We're going to increase our equipment, and then basically here our cash is going down. So we're going to go through and credit cash. How do we decrease an asset? We decrease it with a credit. So on my previous examples, which I'm going to go through and link below, whenever we did a purchase of equipment for the last chapter we were going through and looking at, I always did it right over here, which was the purchase of equipment on 12/31, prepare financial statements on 12/31. Now, the reason why I did this is in no way are cars purchased on New Year's Eve. Just doesn't really, probably maybe some are, but who knows? But the reason why we did this is because if I purchase it during our year, so say if I'm looking at my year, and this is currently 2025. So if I'm purchasing equipment, so we'll say this is 12/31/25, and this would be 1/1/25. If I'm buying equipment at any time other than this, which in this case, we bought this on May 1st. So we'll just say this kind of looks like May 1st. So I buy the equipment, and by definition, I am now putting that property, plant, and equipment into use in our operations. So if we look at our 4 questions, okay, so right over here, we look at our 4 questions. Do our revenues reflect what we've earned when we do adjusting entries? Do our expenses reflect what we've used? Do our assets reflect their future economic benefit? Do our liabilities reflect our future obligations? And then when preparing adjusting journal entries, we never adjust cash. So when we buy it, not on the very end of the period and doing financial statements at the same time, but when we're buying it during the year, this is a little bit different because we're effectively using the equipment from 5/1/25 to 12/31/25. If we're using something in our operations, it means we have to go through and record an expense. So in this case, when we are purchasing equipment and we're putting it into use, we need to record an expense. Well, Bennett, how do we record expenses? Well, debit, credit, ER, the place I don't want to end up this weekend, or the emergency room, assets equals liabilities plus owner's equity. So here, when I look at this, I've got, well, expenses, revenues. How do I record an expense? I'm going to record it with a debit. So I'm going to show the use of the equipment. And this is going to be called depreciation expense. And we'll get to it momentarily, how we compute it and all that other kind of fun stuff. But I'm going to need to record an expense to reflect the use of the equipment during the period of time in which I purchased it. Now, your immediate gut reaction might be is to say, well, if I'm debiting depreciation expense, then maybe I should go through and credit equipment. But if you were to do that, we would get the incorrect answer. So because equipment has physical substance, right? It's physically there. What we have to do is we have to, well, we're going to record the expense, but we're going to basically show the use of that equipment in something we call a contra asset account, meaning that it's going to have a credit balance. So contra assets typically have debit balances, but this is going to be a contra asset account. And we're going to call this accumulated depreciation. A/D, this is not after the death of Christ, but this is A/D equipment. So what we're going to go through and do is as we use the equipment, we're going to be recording depreciation expense. And then what we're going to go through and do is we're going to basically credit accumulated depreciation on the equipment. Now, for our purposes here, there's a lot of different ways you can go through and depreciate equipment. One of the things you can go through and do is you can basically say, well, for tax purposes, I want to write off this entire amount. I want to write off the whole thing. So how do I do that? Well, the way I could go through and write off the whole thing is that in the tax code, there's something called a 179 deduction that allows me to do it. So that's kind of like when you hear like, oh, I'm buying a car and I'm like the write-offs and stuff like that. But the way to depreciate equipment, there's several different ways. We're not going to focus on that right now, but rather what we're going to focus on is the easiest one, which is something we call straight line depreciation. So basically what straight line depreciation is we assume that we will be using the asset pretty much equally over the asset's life, and the cost of operating the asset will remain relatively consistent. This is the theory behind when we're going through and doing this. Now, for depreciation, I'm just making this extremely basic. And the reason is because when we go through and look at equipment way more in depth, we're going to be going into other different types of depreciation methodologies, including double declining balance, including units of production. But for right now, we're basically assuming that we're going to be using this asset equally over the asset's life, basically using it evenly, and more important, that the cost of operating the asset will remain relatively consistent, which basically means I'm going to be taking the same amount of depreciation every month or whatever, however we're going to do it. So how do we calculate straight line depreciation? Well, we're going to go through right and do that right now. The way we calculate it is we're going to say over here is my acquisition cost, or the cost to basically get that equipment up and ready for use. So if I had to pay installation fees, taxes on not regular ones, but sales tax, anything, all costs related to getting that equipment ready for its intended use, that is my acquisition cost. I'm going to subtract salvage value. What is salvage value? Salvage value is the value I can expect to sell the asset for at the end of the asset's useful life. So I've got acquisition cost minus salvage value. And this is all going to be divided by my estimated useful life. And this is going to give me annual straight line depreciation expense. Annual. So again, what are we doing? Well, we're effectively taking this cost and we're going to basically spread it over the asset's estimated useful life. But very importantly, though, because we expect to get the salvage value back at the very end of the asset's useful life, we need to not depreciate that. Very important. So if we look at this question over here, in terms of an adjusting entry for equipment, it is always going to be a debit to depreciation expense and a credit to accumulated depreciation on equipment. And so let's now go over here and look to figure out how to compute it. So, and again, why are we not crediting equipment? It's because equipment has physical substance. And let's go ahead and take a look at sec.gov, right? Fun place to go through and look. We go over here to Apple. And let's take a look. And we're going to see this thing where we see property, plant, and equipment net, right? What does that mean? Does that mean it's on the internet? No, it means that we're taking that and it's going to be net of the accumulated depreciation. Let me just pause real quick and I'll show you the footnote disclosure. So right over here, you see gross property, plant, and equipment, meaning that Apple, and through June 29th, 2024, has purchased 117 billion worth of property, plant, and equipment. Now they may have bought some that they later sold, so it wouldn't be included in that. But as of right now, they have 117 billion of the equipment they went through, and it's still in use. Now, accumulated depreciation. This is a negative 72 billion, meaning that Apple has recorded $72 billion of depreciation over the asset's life. And that gets us to property, plant, and equipment net. This is what we mean by it's a contra asset account. It's not a liability, but because these have physical substance, right? Very important. We do not want to directly credit the property, plant, and equipment account because it's still being used in our operation. So what we're going to do is we're going to accumulate the depreciation in this contra asset account. So does this account ever get closed out to retain earnings? Absolutely not. It is not an expense. It rather accumulates the depreciation expense that we're recording over time. Let's go through and take a look at the rest of our question here. So to compute it, I have over here, and we'll bring this over to make our lives easier. Okay, so my acquisition cost is 300,000. My salvage value is 60,000. And my estimated useful life is 4 years. Now, what is the salvage value? It basically means on the day that I buy this equipment, I am making my best guess at what the salvage value will be or what the asset will be worth at the end of the asset's useful life. So I am expecting that at the end of 4 years, this asset will be worth $60,000. There you go. Okay, so using high-powered math, we get 240,000 divided by 4, or depreciation expense of $60,000. My annual depreciation expense is going to be $60,000 per year. Okay, so I come over here and just happen to be equal to salvage value. That's not always going to be the case. It's just I was trying to get a nice round number, and there you go. Okay, so how do we go through and record it? Well, to record an expense, I'm going to record that with a debit I'm going to go ahead and over here with a credit. So I'm going to say 60,000 and then 60,000, but oh no, that's the wrong answer. Why is it the wrong answer? Because this would have to be for a full year, right? So that's not the answer. The answer is going to be, well, how many months did I use the equipment for? Well, 60,000 is my annual depreciation expense. So I bought the asset on May 1st. May, June, July, August, September, October, November, December. I used it for a total of 8 months. So I'm going to multiply this times 8/12. So basically from 5/1/25 to 12/31/25. So 60,000 times 8/12, I'm going to get 40,000. So 40,000 is my depreciation expense for 2025. So when we purchase equipment, right, and I'll put the links below, but when we purchase equipment, it was always being done on December 31st. And I was preparing my financial statements on the same day. And I did that for a real important reason, because if we bought it during the year, then I would need to record depreciation expense. I have to show the use of the asset. So over here, I'm debiting depreciation expense for 40,000, and I am crediting accumulated depreciation by 40,000. Now, over here, it's asking us, well, prepare the classified balance sheet presentation for the equipment as of 12/31/27. But before we get to that part right over here, let me just move some of this down below. So before we get to 12/31/27, let's go through and take a look at 12/31/25. So my balance sheet presentation is essentially going to look something like what I just pulled up with at Apple. So for balance sheet presentation, right? And remember, when we're doing a balance sheet, we are now looking at what we call a classified balance sheet. What does that mean? It means that for assets and liabilities, we're now looking at this saying, well, if we're going to be using that asset in the next year, it's going to be what we call a current asset. If it's beyond a year, we're going to call it a non-current asset. You'll sometimes hear it being referred to as long-term, but the SEC prefers non-current. So what does that mean? It means it's going to have, basically a life of more than a year. So when we look over here at Apple, we're seeing property, plant, and equipment, right? It is a non-current asset. So what we're going to do is we're basically going to say, okay, balance sheet, SFO, balance sheet as of 12/31/25. So under non-current assets, I'm going to be going through here and showing equipment. Basically, equipment here has a balance of 300,000. Remember, this balance is going to stay there until we sell it or otherwise dispose of it. Now, this has remember, we don't write debits or credits on balance sheets. But over here, we're going to say less accumulated depreciation equipment as of 12/31/25 of $40,000. This is going to give me my equipment net of 260,000. Okay. Now, you might be wondering, well, Bennett, that's great, but it's not the answer. It's not the droid we're looking for. What happens? What about where we have to do this on 12/31/27? And I will absolutely get to that, but I wanted just to kind of show you first basically for the very first year, what this would kind of look like. And let me just move this down a bit so we can give ourselves a little bit more room. Perfect. Okay. So now what we're going to go through and do is we're now going to say, okay, well, what happens in 2026? Right? What happens in 2026? Well, our depreciation expense, like all expenses, that is going to be closed out to retained earnings. It's going to zero out because that tells us how much we use the asset for 2025. When we go to 2026, we are starting fresh. Now, for 2026, I basically have the same two accounts because I'm always recording depreciation expense using the same account. So we're going to have accumulated depreciation on equipment. Now, accumulated depreciation on equipment as of 1/1/26 had a balance because I recorded the depreciation expense in the first year. This is not closed out. My ending balance of accumulated depreciation is going to become my beginning balance for the following period. So that's kind of what's happening over here. And notice, kind of similar to the other part, this equipment account isn't changing. It's just going to stay there until we sell it or dispose of it. So coming over here, how much depreciation expense do we record in 2026? Well, it's going to be the same formula. Basically, right over here, acquisition cost minus salvage value divided by the estimated useful life is going to give us 60,000. So for 2026, I'm going to record 60,000. For every debit, I need a credit. I'm always going to credit accumulated depreciation on the equipment. So this is my depreciation expense for 2026. So my ending balance in accumulated depreciation is going to be over here of 100,000. Okay. So that sounds good. Now we're almost there, right? So if I were to be asked for 12/31/26, the equipment balance has not changed, but my new accumulated depreciation balance is going to be that 40,000 that I recorded in the first year, plus another 60,000 I recorded in the following year. So my equipment net of the accumulated depreciation is going to be 200,000. Now, what happens next? Well, the next year, which is the answer we're looking for, 2027, right? So my depreciation expense, 2027, and my ending balance is going to become my beginning balance for the following period. So my depreciation expense is going to be the exact same thing. I used it for a full year. So coming down over here, what's happened? Well, 12/31/27, this is going to be closed out to retained earnings. Remember, expenses, revenue, dividends all get closed out to retained earnings. This, however, is a contra asset account. It has a credit balance. So that's why you're seeing the negative right over here, because it's reducing the carrying value of my equipment. So on 12/31/27 over here, that's what's going to happen. And we're going to get to 140,000. Now, if I did it for the following year, 12/31/28, as you can kind of see, well, I would be putting here another 60,000 if we just kind of looked at this. So 1/1/28. This is going to be the balance here. If I recorded depreciation expense again, right? So my depreciation expense 2028, it's going to be the same thing. Now over here, my ending balance now is going to be 12/31/28 is going to be 220. Okay. Now, as we go over here, I now have an ending balance here, or basically my book value or my equipment net, you'll sometimes hear this referred to as net book value, which means that the cost minus my accumulated depreciation gives me my net book value. So as we look over here, let's go ahead and do this for 12/31/29. Now in 12/31/29 is kind of an interesting period because let's go through and do this. If I were just to keep on going over here and I said, well, depreciation expense 2029, I'll just take another 60,000 and my balance before 1/1/29. And over here, I've got 280. Now, here's the problem. I have a rule when I'm going through and recording depreciation expense. I cannot over depreciate an asset. What does that mean? It means that I cannot go below salvage value. Salvage value can never go below net, or I should say this, net book value can never go below salvage value. Better way to put it. Here's my problem. My salvage value was 60,000, right? 300,000 minus 60,000. And so here, my net book value, I have a problem. So what does that mean? Well, where did we go wrong in doing this problem? Well, if we kind of look at this asset had a 4-year life. Right? And in each year, there are a total of 12 months. So the total months in terms of life for this asset are really going to be 48. So if we look at this, during 12/31/25, we took 8 months of depreciation, or from May 1st through December 31st of 25. Here we took 12, here we took 12, here we took 12. And before we just got to 12/31/29, we basically had 44 months. So what does this mean? I can only take 4 months more of depreciation on this asset. So when it comes to 2029, where I've got 60,000 of annual depreciation expense, I can only take basically from January 1st through April 30th, right? Because if I started this on May 1st to get to the end of those 4 years, I'm going to basically multiply this by 4/12. So I'm going to get depreciation expense for 2029. So the way this is going to work, I'm going to take 20,000 of depreciation expense. And then basically over here, my accumulated depreciation is now going to be 240. So here I've got 60,000 left. So even if I'm still using the asset, I can no longer depreciate it. Okay. So this part that I've just reviewed with you down here is going to be something I would probably be throwing onto maybe as an extra credit for my class. I don't know. I'm more concerned with you knowing if you're taking my financial accounting class is that, well, can you go through and record depreciation? Record depreciation expense. Do you know what the balance sheet presentation looks like? Right. Those are pretty important things to me. But when it comes to like over depreciating of assets, then it's like, well, not necessarily. I mean, that's going to be a little bit more advanced, but I do want you to understand that the concept of that when you are depreciating an asset, we can never depreciate beyond an asset's salvage value. So this is definitely one of the harder concepts in terms of when you're going through and learning about accounting. I would definitely say that this is one of the more, challenging ones. But again, you're just getting introduced to this. I have several other questions that are up here that you can find on my channel. I look forward to seeing you on the next video. Have a great day.